Okay, so I noticed that some students haven't submitted the part one of lyrics yet. So I'm really nervous for those students. Today is Thursday, Friday, Saturday. You have 2 days. To me, it's almost impossible to get the lyrics done, right? And for those of you who have finished the project, you know how much time you have invested, put into the lyrics. And I'm sure you have learned a lot, right? By doing that case, you have learned a lot of things about journal entries and stuff. But yeah, I was very nervous because some students haven't even submitted part one mark yet. So I'm really concerned. Okay. So for the second category, the FVOCI, so that's the fair value through other comprehensive income. Okay, so the debt, right? Some debt will fall into this category. So basically, right, the intention is both, right? They want to make trade, they want to collecting cash flows. So investments are reported on the balance sheet at fair value. Of course, it's a fair value. And the income, right, the gain or loss is going through other comprehensive income. It's not going to go through the income statement, okay, other comprehensive income. Okay. So we mentioned in the beginning, for the non-strategic equity investment, okay, if it's equity, okay, you classify it as FVPL, but they have an option of special election, okay? So basically, IFRS 9 provides an exception to the treatment of equity investment that is normally classified as FVPL, okay? So you can actually elect to present changes in the fair value through OCI, okay? There are 3 conditions in order to do this election. When you initially require this investment, that's the time you have to make the election, okay? If you own it already for a couple of days, a couple of weeks, that's too late, right? Initially, you made the purchase, then initially you file for the election. I want to present the changes in the OCI, okay? And this election, the investment must be in equity, right? This must be shares. The election is irrevocable, right? You can't change your mind, okay? Once you have this election, your equity investment is always stay in that category. You can't say, guess what? I changed my mind. Now I want to revoke my election. Now I want it back to FVPL, okay? So why they have this kind of requirement? Why the accounting standard set up these standards, right? This guidance. The reason for that is there's a big difference between recognition of through the income versus other comprehensive income. You remember we talked about earnings management, right? Suppose you have a gain, right? You have a gain. And if you want to manipulate your earnings upward, you would hope the gain is recognized on your income statement, okay? If you have a loss, you would hope this loss does not flow through the income statement. It's recognized in the other comprehensive income, right? So they don't want the company, the managers, to cherry pick, right? To manipulate the earnings, right? You can't use this tool, right? This vehicle as a way to manipulate the earnings. Therefore, okay, what initially you bought it, you are saying my intention is this intention, not for short-term trading. Great. So then they allow you for FVOCI, okay? But once you make that election, you can't change your mind, okay? So your investment always stayed in that category. So that's kind of, we are talking about this special election only for non-strategic equity investment. It has to satisfy the 3 conditions. So I will show you the differences, okay? Oh, sorry, before that, I still have maybe one more slide here. So this equity investment with OCI election is not exactly the same as FV OCI, okay? Even though the special election for the equity is OCI, but the equity instrument with OCI election is different from the FV OCI, right? Why? I'm gonna show you, okay, in the next example. The dividend received is still recognized as income, dividend income. Upon sales derecognition, the realized gain loss does not flow net income statement. It's continued, goes through the OCI. That's the difference, okay? So for the FV OCI, realized the gain or loss when you sold, disposed your investment, those realized gain and losses will go through net income. You go through your income statement under FV OCI. But for equity instrument with OCI election, okay, all the gains, losses, regardless realized or unrealized, go through OCI, okay? Did I make that clear? Any question? Good, good, I can move on.
Yeah, it makes sense.
Okay. Okay, so so what's the difference, right? What's the difference is the cumulative OCI, okay? They will never reach the income statement, okay? They will be directly transferred over returned earnings. So it never goes through the income statement, okay? So that's the difference. So let's take a look at the same journal entry. So the same question we did together. Let's assume that the company failed this election, okay? Failed this election. So I want you to pay attention to those red texts, which are the differences, okay? So this is not FVPL because this is the equity investment with OCI election, okay? So you debit this, okay? For dividend income is the same, debit cash, credit dividend income. Here, the changes in the value, did you see? Credit OCI gain losses, okay? Here, December 31st, debit OCI, okay? OCI. So for the recognize the changes in the values, the unrealized gain losses, this is all go through OCI because this is the OCI election, right? On January 21, okay, this is the realized, they sold these shares. This is realized gain loss, right? But they still go through OCI, okay? They still go through OCI. You see a difference between the two different categories? For the non-strategic equity investment, if you are not making this election, everything is FVPL, okay? So both unrealized gain or realized gain losses all go through income statement. But if they made a special election for the equity investment, both realized gain and unrealized gain losses all go through OCI, okay, OCI. So you see that the numbers will affect the earnings, right, the net income. So therefore, the accounting efforts does not want you to change back and forth, right? They don't want you to take advantage of the circumstance to benefit the earnings, okay? So once you make this election, you cannot revoke it, okay? Any question? Okay, no question. Okay, so now I'm going to compare this realize how the treatment on the realized gain. Okay, when you sold or disposed your shares, if it's a equity instrument with OCI election, okay, and so that realized gain goes through OCI. Okay, I want to make it really clear, so I bold it and make a larger font size. Okay, if this is no election, it's FVPL. Okay, FVPL. If suppose this is FVOCI, okay, FVOCI, realized gain will go through income statement. Okay, so this is both income statement for realized gain. So for realized gain, okay, under FVPL and FVOCI, both realized gain will go through income statement. Okay. But for the equity instrument with OCI election, that go through, realized gain go through OCI. Does that make sense? Are you tired?
Yeah, it makes sense.
Okay, thank you, Jason. Okay, let's do a question. Okay, I think this will help you to. So BWC purchased 1,000 shares of Scotiabank on March 11, 2021, when the share price was $58 per share. At the close of December 31st, 2021, the price of Scotiabank shares had declined to 50. On November 2nd, 2022, when the company sold the shares, the price had recovered to 55. So during 2022, BWC received dividend of 2.14 shares. Okay, can anyone tell me what's my journal entry on March 11th?
This is under FVOCI, right?
This one, let's take a look. 1,000 shares of Scotiabank. Do we have an election? No election, right?
Oh, okay. So it would be debit, FVPL,
Yeah.
Scotiabank investment, and credit cash to buy the shares?
Yeah, and for 58,000, right?
Yeah.
Okay, you debit FVPL investment in Scotiabank shares, credit shares for 58,000. Very good. And now December 31st, okay, 2021, you have to update the account with fair value. So we learned now the price is $50. So the price dropped $8 per share. What's my journal entry here?
You debit gain on FVPL investment and credit FVPL investment BWC.
For how much?
So for the difference, that's 8,000.
Very good, thank you. Very good. You debit loss from the
loss.
Yeah, very good. Yeah, because when you debit, I know you mean loss. Yeah. You debit loss from FVPL investment for $8,000. You credit FVPL investment for $8,000. Okay. And the next year, November, they sold the shares. Okay, and they sold it for $50 per share. Actually, in November, in 2022, they received the dividend. What's my journal entry for that?
Debit cash, credit, dividend income.
Very good. So 1,000 shares times 2.14 per share, so 21.40, right? So that's the entry to recognize the receipt of the dividends income. And November 2nd, 2022, they sold the shares. At this time, the price is $55. What's my journal entry?
So you debit cash 55,000, and
Good.
you credit gain on FVPL investment as BWC.
Mm-hmm.
It should be 5,000.
Okay, good. Very good. So you debit cash for 55,000. How do you know that? Your price, your selling price is $50 times 1,000, 55,000, right? And you credit the FVPL investment. So that's 50,000, right? Because initially the balance is 58,000, but they decreased by 8,000. So at this point, the account balance is 50,000. So you sold it, you have to credit that balance 50,000 to close the account. So you credit this FVPL investment for 50,000, and the difference would be a credit, and that's a gain through the income statement, right? 5,000. Very good. Awesome. Okay, looks like you are pretty okay with this kind of journal entries. That's good. Okay, reclassifications from one category to another. Okay, reclassifications from one category to another. If you remember that we talked about the derivatives, right? For the purpose of this course, just remember it's classified as FVPL for derivatives. For equity, remember it's classified as FVPL unless there is a special election, right? So for debt, it could be potentially classified in one of the three: FVPL, OCI, and amortized cost. Okay. So the question is, what if the company wants to reclassify the category? Okay, and only for the debt instrument, right? Because for derivatives, equity, there's no option for reclassification. So for equity and for derivatives, there's no option for classification. So the option is only available for debt, okay? And there are three possibilities. So then two, right? So then you can see there are 6 combinations, right? 6 combinations. So there's 6 cases, scenarios. There's only 6 possible scenarios, okay? So if you are in FVPL, you want to reclassify it into the other 2 categories. If you are in FVOCI, the other 2 categories. If you are in the amortized cost, the other 2 categories, right? So there are 6 possible scenarios. And you can see that IFRS have a very good regulations in terms how you're going to deal with this, right? The changes in value up to the reclassification date, how are you going to deal with it? So it's pretty clear, right? How you're going to do it. I don't want to spend a lot of time on this, okay? The reason for that is I think we should spend more time to know what is amortized cost, right? You should know this from finance, but I'm really concerned here. My previous experience is that students didn't do well in the finance. They struggled with about present value situations. So the idea, there are 2 basic rules when you think about reclassification. You tend to think about it as you dispose on the reclassification date, you dispose it, okay, and then you repurchase it, okay? That's one thing you want to think about it. The second way to think about it is the case 4 and case 6, okay? When the FVOCI is involved, okay? In these 2 cases, you treat it like that it was always in case 4 amortized cost. For case 6, the way how you treat it is like it was always like the new category. Okay, case 4, case 6. This kind of change has only prospective implication. You don't go back to the previous years to make changes. Okay, so keep in mind this has only prospective implications. Okay, going forward. The details. Okay, how are you gonna do this? In terms of the details, I don't have time to show you one example. How to do this. If you have time, read the chapter. Okay, read the textbook. They give you some examples. Okay, they did a very good job in explaining the reclassifications. Unfortunately, I don't have time to cover this part for this lecture. So for your own interest, make sure you just read the textbook. Okay. In the future, if you ever run into a situation like that, you know that the IFRS 9, they give you a clear guidance in terms of how to deal with these situations. Okay, so there are 6 possibility scenarios for the debt investment. You are allowed to reclassify into different categories. Okay. Okay, so let's take a look at this example. Okay, you tell me which category it goes. Okay, you tell me. Shares without an irrevocable election. Which category?
FVPL.
PL.
Good. B, bonds classified as FVOCI.
FVOCI.
Thank you. C, bonds held to collect contractual cash flows.
FVOCI.
FVOCI. That would be also have a trading option. In order for the debt, the bond to be classified as FVOCI, they also have a trading option there, right?
That's amortized cost.
Amortized cost. Okay.
Yeah.
Derivatives on foreign currency.
FVPL.
Okay. Bonds held to collect contractual cash flows and sold for profit.
FVOCI.
FVOCI.
Okay, very good. Awesome. So we are moving on. Any questions, by the way? Okay, I will move on. Okay. So this is the part. I think if you know finance really well, you should have no struggles. But my previous experience is like my student didn't know finance very well. But I was concerned I don't have enough time for this lecture. So I made a video about 2 days ago. It's called a bond, okay? Bond is one of the typical form of the debt instruments, right? Bond. So I made a video. Did anyone watch that video? For bond? Okay, so if you are not comfortable with finance, I would encourage you to watch that video, okay? I was explaining something about the different coupon rate, right? Yield rate, market interest rate, contractual rate, and how the market interest rate affect the price of the bond. So yeah, so I really hope that if you don't know all these stuffs, make sure you watch that video. So basically for amortized, okay, amortized cost category, okay, we are going to create an amortization schedule, okay. What is amortization schedule? If you own a car or if you own a mortgage, right, you have amortization schedule. So that schedule show you that over the period of the mortgage or the loan, there are a number of payment, right? Maybe you pay mortgage monthly, and you have a fixed amount of payment every month, right? And then they will show you for each period, right? For the total amount of payment you made to the bank, what is the portion is for your principal, and what is the portion is for interest expenses, right? And what's your ending balance of mortgage at the end of the different timing point, okay? That's called the amortization schedule. In order to create that, you have to know how to use present value, right? You have to know how to calculate present value, okay? But the reason why the personal finance is a prerequisite for this course is that you see now, right? You will benefit from your solid knowledge about the personal finance. So at first, when we prepare that amortization schedule, I first require, okay, the effective interest rate method. So what do you mean by that? I'm gonna explain that soon. So effective interest rate method, okay, basically you are, okay, calculating the value, the amortized cost, okay, the value to be reported on the balance sheet, okay. You are using the present value, okay, of the future cash flows to be generated by this instrument, and you are using a discount rate. So when you do present value, you use a discount rate. So you are using the discount rate is the effective interest rate or the yield rate, market rate, whatever. You use that rate to discount the future cash flows to be received based on the instrument, right? The debt instrument. So I will explain more about this, okay? Does anyone familiar with what I'm saying? Just give me 1 second. I just want to quickly take a look how everyone is doing. If you know what I'm talking about on this slide, can you please raise your hand? Sorry, can you please thumb up? Okay, so there are some. Okay, so how come I only see once? Okay. I don't see a lot of, okay, so, okay, let's do one more time. Sorry. 1, 2, 3. Can you sum up? I want to see how many people understand what I'm saying. 1, 2, 3, 4, 5, 6, 7. Okay, 8. Okay, so there are 25 of us. 8 people are quite comfortable with this. Okay, so make sure you are going to watch that video I made. I already posted. So, okay, I'm going to explain more about this. Okay. Okay. So what is the effective interest rate, okay, or yield rate? So basically, a good reference point for finance would be the market interest rate, right? A market interest rate. Sometimes the company will have something called RRR, internal rate of return. When they do investment, they are hoping to get back an investment, certain percentage, right? They call it IRR. So this is all the potential discount rate people can use. But for the bond amortization cost purpose, we are using effective interest rate or yield rate. For these courses, we are going to give you this number, okay? I'm not going to ask you to figure out what's the effective interest rate. So this information will be provided in the exam, okay? So there are 3 types of bonds, okay? 3 types of bonds. The bonds have a face value, okay? So the bond can have a face value of, let's say, $1 million, right? So then they can have a promised interest rate. So they are going to give you, let's say, 5% of interest, okay? So maybe they will make an annual interest payment. So the annual rate is 5%, $1 million face value, and they only make an annual payment, okay? So for each payment, you receive a cash, 1 million times 5%, okay? So what is that? $50,000, $50,000, okay? So every year you receive a cash flow, a cash, $50,000. So the face value times the promised rate by the issuer, 5%. And the promised rate is also called contractual rate, stated rate, coupon rate. Okay, there are different way to say it, right? So like a coupon rate, contractual rate, okay, stated rate. This is all a term to say about the promised interest rate by the instrument. Okay, so then if the face value is 1 million, the coupon rate is 5%. It's made annually. Okay. Another information is the maturity, right? Maybe the bond will be mature in 3 years. Right? At the end of the 3 years, they are going to give you back the $1 million, the face value. Okay. So it's a piece of paper with a face value of 1 million, promise you 5%. Okay, and the interest paid made annually, and 3 years, people can redeem this one for the face value, right? At the end of the year 3, they give you back the face value 1 million. Okay, now the question is, when you first issue this bond, okay, what's the price? What's the market price for this bond?
Sorry, could you repeat the question again? I had poor internet.
Yeah. So what's the price of the bond? If somebody wants to buy this bond, how much they should pay for?
Usually $1,000, isn't it?
The face value is 1 million, right?
So it'd be
at the maturity date, they are going to return $1 million to you, right? And every year they are going to give you $50,000 cash as an interest. So how much do you think this instrument worth today? The price you are willing to pay? So you buy this for cash flows, right? So you buy this because you have 4 cash flows. So 3 years, every year you have $50,000, right? Year 1 you get 50,000. Year 2 you get 50,000. Year 3 you get 50,000. And at the end of the year 3 you get $1 million, right? So this is the future cash inflows. Good. Everyone wants it. Everyone wants cash inflows. I can take more cash if you have extra cash. Okay. But the thing is, what's the cost on me, right? So how much you are willing to pay to buy this instrument?
I would say the most you should pay is 1,150,000.
1 million, 100, 1 million, 1.5 million?
1.15 million.
1.15, right? So you are saying, right, the 50,000 times 3 plus 1 million, right? Yeah. But then did you consider the time value of money? Because you are just using undiscounted cash flows, right? Remember, these cash flows are in the future, right? And you are paying the price now. Right?
Yeah, I guess you could include time value money to your price also.
Yeah, exactly, right? And then when you discount your time, when you use the discount rate, what's the rate you are going to use when you discount? We are using the market interest rate, okay? Market interest rate. Okay, so now let me ask you, okay? So this bond issuer promised you a 5% interest rate, right? What if the market interest rate now is 6%? So if you invest elsewhere, you can get a market interest rate for 6%. And this debt only promises you 5%. How much are you willing to pay for this bond?
At a discount.
At a discount, right? At a discount. So you are saying, I'm going to sell my bond, face value is 1 million. I want to sell it for 1 million, right? And give you 5% interest rate every year. Okay? But why would I buy your bond? I can invest my $1 million elsewhere to earn 6%, right? So there are somebody else in the market are willing to give 6% interest rate, and your coupon rate is only 5%, okay? So if I have $1 million, why would I buy your bond? I can buy the other players in the market. I can earn 6% of interest instead of 5%, right? So how can you sell your bond? You tell me, how can you sell your bond?
You sell it at the price that is lower than the face value.
Yeah,
so
exactly, right? Yeah. So you are going to sell it at a discount, right? Because otherwise nobody will buy your bond, right? Because the promise, the interest rate is too low compared to the market. Okay. So in that case, if the promise rate, the coupon rate, if that's lower than the market rate, so your bond will be issued at a discount value, okay? Will be under your face value. Okay, what about the market interest rate is 4%. So elsewhere, they only offer you 4%, but this bond issuer gave you 5% coupon rate. What is gonna happen?
You can sell it at a premium.
Yeah, because everyone wants it, right? I want it, you want it, everyone wants it. The market is smart, right? Everyone is going for the maximizing their return, right? So then there is this economics in, right? If there's a demand, the price will go up, right? Okay. So then you sell the bond at a premium above the face value, right? So there's only 3 possible situations, depending on the relationship between market interest rate. You can also call the effective interest rate or yield versus the coupon rate, promise rate. If they are equal, what happens? If they are equal, so the market rate is 5%, they promise you 5%, and this coupon is $1 million. What's the price of that coupon?
it will be $1 million.
Yeah,
so the same thing.
Yeah, it's the par, right? The par. So there are only 3 situations. When the market rate, coupon rate is equal, it's a par value. So the bond will be sold at the face value. Okay. If the market rates go up, okay, so everyone will want to go to the market to invest. So if you want to sell your bond, you have to reduce your price. So if the market interest rates go up, the bond price will go down. Okay. So that means you are going to issue at a discount. Okay. If the market interest rate go down, your price will go up. This is kind of like what is called. My kids always play this game. 2 people sit on one end of this thing, up and down.
Seesaw?
Yes, thank you, seesaw. It's just at the tip of my tongue, I forgot. So it's like seesaw, right? The market interest rate and the price of the bond. If market interest rate go up, okay, the bond price will go down. Okay, if the market interest rates go down, okay, the price will go up. Okay, so just knowing that there are 3 types of bond, right? They could be issued at a premium or at a par or at a discount. Any questions? Did you learn this in finance course?
Yes.
Okay, I'm just recapped everything. Okay. So what happened is, okay, suppose you have a premium, okay, at the beginning of the purchase date, you have a premium, and over the time at the maturity, what's the value of the bond at the maturity?
The value will be 1,000 or 1 million. It's
The face
always
value, right?
yes.
Remember, regardless how much you issue it, at the end of at the maturity date, they only give you face value, right? So they only give you face value. So that's how much it's worth at the maturity date, the face value, right? So that means there's no premium or discount at the maturity date, right? The price of the bond the company buy it back is equal to the face value. There's no premium or discount, correct?
Yep.
Yes.
If there's a discount, then the company should not give you face value. They will give you lower than face value, right? If there's premium, the company will have to give you more, right? The fact the company only gave you 1 million at the maturity date, that means there's no premium or discount, right? So did you see the picture of this picture? So at the maturity date, okay, at the maturity date, the amount of premium or discount is 0. At the purchase date, there is a value of premium or discount, but over the time, the amount of discount or premium will be reduced to be 0 at the maturity date, okay? So then this looks like the amortization, right? You see that? You start with a value, you end it up to be 0 over a period of time. This is amortization, okay? So over the period of the amortization, this schedule, you are amortizing the amount of premium and the discount, okay? Okay, so that's what we talked about, effective interest rate method, okay? So how are we gonna do a calculation, okay? So the bond will have a maturity date. They will have a face value, or we also call it a maturity value, coupon payment or coupon rate, and the frequency, right? So the coupon, the cash payment can be semi-annually, quarterly, right? It's really depending on the nature of the bond. It could be annually, semi-annually, right? And the market rate, yield rate, effective interest rate, this is the discount rate, right? Discount rate when you do the present value calculation. Okay, so now I'm going to use problem 7-39, okay, to show you how this works, okay, to show you how this works. So Armstrong Corporation purchased a bond with a maturity value of 10,000 payable in 5 years. Okay, these bonds have a 6% coupon rate payable annually. Armstrong paid 10,890 for this bond, giving a yield of 4%. Okay. So, what do we know about the bond? The face value is 10,000. How long? The length of time? 5 years. Okay, 5 years. Coupon rate? 6%. Frequency? Annually. Okay, and the market rate, yield rate, 4%. Okay. Now, do you remember how to calculate the present value? Do you remember how to calculate the present value?
Yes.
Okay.
So the formula is the face value divided by 1 plus r raised to power the number of years.
Okay, very good. So that's only one part of it, right? That's only one part of it. Okay, so let me see what I can do here. Okay, so can I draw something? I can draw here. Okay, so in this question, there are 5 years, right? 1, 2, 3, 5. Okay, yeah. So let me see here. The face value is 100,000. Okay, and the coupon rate is 6%, right? And this frequency is annually, right? Annually. What's the amount of cash payment? So I want to know the cash flow, right? 0, 1, 2, 3, 4, 5. So I want to know what's the future cash flow look like. So for this kind of questions, I always want to know what is the cash flow structure look like. Okay, so I'm going to draw this picture. This is the 5-year period. Okay, 5-year period. So what's the cash payment for every year in terms of interest?
$600.
600, right? So where is it? Okay, here. So 600 here. So 600 here, right? At the end of each year, you are going to get $600 cash, right? For 5 years. And then at the end of the 5th year, you are going to get back your face value, 10,000, right? Okay, so you see there are 1, 2, 3, 4, 5. So these 5 cash flows are equal amount, all 600 every year. We have a name for this. Do you remember? What do we call this? A series of cash flows with equal payment, with equal amount. A series cash flow with equal amount. What do we call this? Come on, you have learned in finance.
Annuity.
Annuity, yeah, very good. This is called annuity, right? So you have annuity here, okay, and then you also have. Can you see my graph?
Yes.
Are you able to see my graph?
Yes.
Okay, and you also have this 10,000. This is just one-time lump sum payment, right? Okay, so now you want to calculate what's my value here, present value here. What's my present value? So you have to discount all these cash flows, right, to the present value. Okay, so this is a regular annuity. Okay, you're gonna look up the table, right? So the annuity, what's my N? In the table, I also posted the present value table on the Moodle website. On table 2, that table is about annuity. Okay, in that on that table, you are going to need N and I. Okay, to find out what's the discount factor for this annuity. Okay, so what's N here?
5.
5, good. What's my I?
6%.
6%. That's the coupon rate.
Oh.
This I is the
It's 4%.
Yeah, 4%. This I is the discount rate, right? So don't confuse between coupon rate and yield rate, market rate. Coupon rate, you use it to calculate your cash payment, right? The coupon rate is useful when you determine the amount of cash, right? That's the promised cash flows. But when you are doing present value, this rate is the discount rate. Discount rate is the market rate, not the coupon rate, okay? That's 4%. So can anyone tell me what is this? What's the discount factor? It should be less than 5. This number should be less than 5. So what's the discount factor? Are you, do you have a, okay, let me see. Okay, so I think I will show you. So I'm really concerned if you are not comfortable with the finance, you will be really struggled with these things. Okay, so I posted this table here. Where is it? Here. Present value table, okay? So this table is this is for the one-time payment, okay? Table 1. Table 2 is for ordinary annuity, okay? So I want to figure out what's my discount factor. I is 4%, so that's this column, okay? N is 5, right? N is 5. N is 5. So 5 for, I have 4.45182. 4.45182. 4.4582. Okay, so this one is 4.45182, right? Is that right?
Yep.
Okay, so then I know these numbers, when you discount to present value, okay, I use this discount factor times 600, okay? Anyone have a calculator to help me with this?
So it's $2,671.10. Sorry, and 9 cents.
Okay.
09.
Thank you. Okay, so that's my present value of the 600, right? So if you do not discount it, 600 times 4, that's 3,000, right? 3,000. When you discount it, your number should be lower than 3,000. So this is 2,600 something, okay? So that's annuity. So we are done with this annuity. For this 10,000, that's a one-time payment, okay? We are going to use, okay, where is it? We are going to use the other table, table 1 here, okay? So again, I is 4%, N is 5. So 0.82193, 0.82193. Okay. So I'm going to do this 0.82193. So that's the discount factor for this. So I'm going to times 10,000. So this is going to be 8,021. Sorry, 219.3. Okay, so now what's my present value? I will sum up these two, right? I will add these two together. These two together, I get, let me see, 0, 1, 9, 8, 10, 39, right? Okay, is that right? 10,890.39, right?
Yep.
So that's my present value. Okay. Okay, first of all, are you willing to pay 10,890 for this face value 10,000 coupon debt? Yes or no? Yes.
No.
Why? Because the market promised you a 4%, right? Right? The market promised you 4%. This bond issuer promising you 6%, more than 4%. Everyone wants it. So the price will be higher than the face value, right? Market interest rate is higher than the coupon rate. So the bond is issued at a premium. So it's more than face value 10,000, right? Right?
Yep.
Yes or no? So that's how you know this price. See? So the company paid 10,890 for this bond. Okay. Now you know how you get this number. Okay. Does this make sense? This you should have already know this in the finance course. Okay. So
I got a question. Where did that 0.82193 come from?
oh, you use the discount factor for this one-time payment. So this $10,000 is the one-time payment in 5 years. Okay. So you looked up this one-time payment discount factor, which is 0.82193, and times $10,000. So that's how you get this number.
And that's from the present value. Is that from the present value chart?
Yeah, I will show you here. So this is a table 1, the present value. Okay. So 4% and n equals 5. So 0.82193.
Okay, thank you.
No problem. Are we okay with this?
Sorry, could you show the formula for the first one, the 4.45182 on the table?
On the table?
Yes, please.
Table 1, and here is table 2. This is the formula. If you are good at math, you should be able to figure out this formula. Okay. But this is accounting courses. It's not a math major. I don't require you to know how to figure out this number. If you are interested, I can definitely make a video to show you how you can how you get these formulas. Okay. But again, for accounting students, you only need to know how to look up this table, how to use it. Yeah.
Are we allowed to use a financial calculator for final exam?
The thing is, if you use your calculator, you tell me a number. What happened is, what if your number is wrong? Let's say when you plug in the number wrong, right? And you get a wrong number, then you lost all the points, right? If you do it like me, like what I'm doing, okay? So if you do it like what I'm doing, at least you get partial marks, right? I can see when I did it wrong. Does that make sense? Because if you go through this, you demonstrate your understanding, right? You understand this. If you happen to use the wrong number, you still get the partial marks. But if you plug into your financial calculator, you get a wrong number, then you lost all the marks, right? Does that make sense?
Okay.
Maybe that's the problem, right? Did you, in the finance course, did your teacher ask you to learn how to do the calculation this way? Just how to do when I was taking the finance course, I had to look up a table to figure out the calculation. I have a financial calculator, but they want us to learn how to use it, okay? So I don't know how did you learn your finance?
Use the financial calculator.
Always use the financial calculator?
Yeah.
See, that's the problem, because right now, what if that's probably why, my students struggled with this part. Okay, so if you always use financial calculator, I'm okay, right? But if you get your number wrong, then you lost all the points, right? So because how should I say it? If I award like 2 marks for calculating the present value correctly, and you use the calculator, you get a number. The number is wrong, then you lost all the marks, right? But if you know how to do it, you set it up this way, and you get a number wrong, and then I see, oh, you know this, so then I can show, oh, you made a mistake here, maybe a typo or something. I can see, right? You may not be penalized that much. because you are demonstrating the calculation instead of just plug in the number and then you get the wrong result, right? Does that make sense?
Yep.
Unless you are saying, guess what? If you in the final exam, if I ask you to calculate the present value, I give 2 marks for calculating it correctly, right? And then you use your financial calculator, you put in a wrong number, then you are saying, because I put a number there, you still give me a partial mark. Do you think that's reasonable?
Yep.
If you laid out your calculation, your number is wrong, maybe I can give you some mark, right? I can see, oh, you made mistakes because you put a typo here, right? At least you understand how to do it. But if you just put a number, that number is wrong, how can I give you a partial mark? That's my concern, right? I'm just trying to think for your benefit. If you think it's reasonable for me to give you the full mark, let me know, okay? Right now, we can make a deal, okay? I'm pretty much open. Then I'm thinking, how should I give you a partial mark? So the question is ask you to calculate the present value, and you calculate it wrong, and you only show me a wrong number. How can I give you a partial mark? Okay, let me know your thoughts, okay? What do you guys think? Should I give or I don't know.
I think your way is better.
I'm
Right?
a fan of partial marks.
Yeah, because what happened is, this is the starting point, right? You are going to first calculate the present value, and then you are going to prepare the amortization schedule, right? So it's very critical you have this number right, okay? When I was a student, I do things different ways to make sure I get my number right, okay? I will calculate using the formula, okay? I can look up the table, and I can use my financial calculator, right? When I have a lot of time left in the exam. So when I use different ways to confirm my answer is right, I know for sure my answer is right, right? So if you just plug in, if you just know how to punch on the table, what if you forgot a minus sign? What if you forgot how to enter the number, right? So I don't know. Just for the benefit of learning, I heavily discourage my kids to rely on calculator. My kids is learning math, right? I don't want them to use calculator because they will never learn math, and which is a very important subject in your life, right? Doesn't matter what you do for job, for career, right? Only if you know the mechanisms, then you can rely on calculators, right? That's probably why I see my students struggling all the time. They get the number wrong. It's just because they don't know how to do it. And when they put in the calculator, they probably entered it incorrectly and they got the wrong answer. Yeah. Okay, so this is the present value. And then, okay, we are going to use this present value to calculate for year 1, okay? For year 1, you are going to calculate. If you are not following me, it's okay because I already write the scripts. Okay, I posted a written scripts about this question. It's a PDF document on the Moodle website. Okay, if you struggle with finance, which is not my problem. Okay, make sure you read my scripts. I write everything out about this question. Okay. So it's 4-page long. Make sure it's very detailed explanation. I hope that after reading that document, you'll be pretty clear. And let me know if you still have a question after reading that explanation, okay? So in year 1, okay, what's my interest expense? So we are using effective interest rate method. We are going to use the net book value, which is the balance, the opening balance, times market interest rate. This is how calculate interest expenses. So anyone help me to do the calculation? What's this number? So it's actually 400 something.
435.6.
0.6. Thank you. Yeah. So this is your interest expenses. You use your net book value. That's the the balance of your debt. Okay. Times your market rate. That's your interest expenses. Okay. What is the amount of cash received? $600.
Yes, 600.
Okay. And guess what? There's a difference, right? Difference. So the difference between these two numbers, that's going to be 1644, right? 1644, yeah. Why there's a difference? So your income, right? You are receiving the cash. So your interest income should be 435. And why they give you 600? Because they're stupid?
That's the coupon rate. That's their commitment.
Okay, think about it, right? If your interest income you can earn from market is $435, okay? How come these people is willing to give you 600 cash?
They're nice people.
Because you paid more.
It's only because you are nice to them
more.
first, right? They are kind to you because you are kind to them first. You are paying them you are paying them a premium, right? So you pay them a premium, $890, right? And they are returning this to you now. So in the first year, they return you back $164.40, okay? This is the amortized amount, amortization of premium. Okay, this value 164.40 is the amortization of premium in the first year, right? So in the beginning you give them $890, okay, extra, right, more than the face value, and they will give you back in the form of cash, right? And they will give back over the 3 years, okay? And the first year they give you back over the 5 years, and the first year they give you back 164.40, right? Does that make sense?
Yes.
Okay, so I'm going to show you this document. So I know students struggle with these kind of things, so I read everything out, okay, just for you to read. So this is the question. Okay, so here, okay. So that's your opening balance, 10,890, okay? And your interest income is 436, and they give you cash 600, okay? So they give you back part of the premium, okay? They give you back a portion of the premium, which is the amortization of the premium. So now the premium is lower. Your original premium is 890, okay? Now your premium is 726, okay? So now second year, your opening balance is 10,726, and you times 4%, your interest income is 429, okay? And the cash is still 600. The difference is 171. So that's gonna further reduce the premium to 555. And over 5 periods, okay, remember, at the end of the day, the amount of premium is 0, okay? So at the maturity date, your value should be 10,000, okay? And then they will give you 10,000 at the maturity date, okay? Does this make sense?
Yeah.
Yes.
Yes.
Okay, very good. This table is called amortization schedule. If you get car loans, you get like a mortgage, right? You know, similar ideas, right? Similar ideas. Okay. If you are lost because you didn't do a good job in the finance course, that's okay, because I'm willing to help you. You just read through this whole thing. Hopefully your knowledge will be refreshed. Okay, I discussed everything clearly because I know this is the point students often struggled. Okay, and it's important you know this. Guess what? In the next course, 3101, you still have to know this, because in the financial liability part, it's the opposite. Now we are talking about the investment, financial assets. But for the companies issued this instrument, they are financial liabilities or equities. So then you still have to do the same thing, right? So might as well learn it now, right? Why would you wait until next course to learn it? Trust me, some students I taught in the 3101, they really struggled with this. And I was wondering, how did they pass 3100, right? So make sure you know how to do this, okay? And I even show you what the journal entry is like, okay? So this is a very detailed explanation about this question, and make sure you understand it, okay? So the premium, okay, goes from, in the beginning, this amount, until to 10,000. So that's this picture. Oops, sorry. Remember, I showed you this picture. Where is it? Here. Do you remember this picture? At the beginning, at the purchase date, you have amount of premium, and over time, that premium will be zero, right? Because the company returned your premium in the form of excessive cash payment, okay? And over the time, the total amount of the excess of cash payment is equal to the initial premium payment. So nobody is stupid, okay? It's a fair game. Do we have any questions on this? Can I move on? Good or yes or no?
Yeah.
Yeah. Okay. I want to. So if you I want to really see if it makes sense. If you understand, please sum up. If not, make sure you take a look at my written scripts. 1, 2, 3, 4. Okay. Wow. 5. Okay. I failed. I think I failed. Okay, who is your finance professor? No, I'm just joking. So okay, so 5, so 20% of people got it. For the other 80%, can you please? I don't have more time in the class. Can you please go to this course website under Chapter 7, and there's a PDF document, detailed explanation on problem 7-39. And trust me, you will benefit from knowing all this stuff because you have to use it again in the next course, okay? You will be really struggling if you don't know this, okay? So anyone want to have anything to say before I move on? Okay, I will move on. Okay. So if the debt is classified as amortized cost or FVOCI, you have to come up with amortization schedule, which I just showed you, right? that table. That's your bond amortization schedule. You need to figure that out. Impairment of the investment in debt. Okay. So if the debt is classified as FVPL, you don't have to conduct of impairment evaluation, because you always run through the impairment based on the fair value, right? Because fair value fluctuating, and the gain losses always go through the net income, right? So that's okay. So you don't have to assess impairment if it's classified as FVPL, okay? If you classified it, the debt is classified as FVOCI, okay? You need to make assessment on the amount of impairment, okay? And the impairment, okay, will be reported in the income, not in the OCI. The impairment is like realized loss, right? So for OCI, remember, if it's a realized loss or realized gain, it goes through the income statement, net income. So the impairment, if you assess there's impairment, okay, then that should go through the income statement, okay. Okay, so this is probably my last slides. Yeah, it's my last slides. How are we doing with time? Okay, 8 minutes. So now let's compare IFRS versus ISB. Okay, IFRS versus ISB. So for joint arrangement, under IFRS, we have joint operation, joint venture. Okay, so they are using proportionate consolidation equity method. You're going to learn more how to do these calculations in advanced financial accounting. For ISB, the terms they use is jointly controlled operation, jointly controlled assets, jointly controlled enterprises. Okay, and they have their own method to deal with the situation. Classification. IFRS 9 classify financial assets according to management's intention. Remember, they hold it to trade, to receive contractual cash flows, or maybe both, right? For ISB, basically, they classify investment by their nature, equity, debt, and derivatives. Non-strategic investment, okay? So FVOCI, that's one of the categories, okay? And unrealized gain losses going through other comprehensive income. For ISB, right, remember, there's no concept of OCI under ISB. So other comprehensive income is a term under IFRS. Okay, under ISB, there's no such concept. Okay, and the non-strategic investment, measurement of equity investment. Okay, so basically, equity investment reported at fair value. Okay, unrealized gain losses through the net income, FVPL. Okay, for the ISB, the enterprises measure, okay, the item and the quoted active market fair value, and the gain losses also go through income. Okay, however, if there's no active market, the equity has to report it at a cost, not fair value. Okay, see the difference? This one and the IFRS is always at fair value. ISB, you could report it at fair value. You should report it at fair value if there's active market. If there's no active market, go with cost. For investment in debt, okay, they could be classified into the 3 categories: FVPL, FVOCI, and amortized cost. Okay, and we are using effective interest rate method to calculate the amortized cost. For the SB, you could use either effective interest rate method or straight line method. Okay. In the other video, the bond video I posted, I talked about the difference between the effective interest rate method versus the straight line method. Okay. So that's the main differences between IFRS and SB. Okay. So we still probably have a few more minutes. Let me see, what time is it? 4 minutes. So I'm open to any questions you have. Okay. Any questions? I'm open to for any questions you have. We still have 4 minutes. If you have no question, just you know, we are done today. I posted some new videos and new documentations. I think you should take a look if you want. If you have no questions, we are done today.
Thanks.
Thank you.
Bye. Have a good night. Yeah. Bye.
Thank you.
Thank you.
You're welcome. Yeah.
Thank you.
Have a good night.